While markets celebrated new record highs this week, the real story unfolded beneath the surface. The S&P gained just over 0.5% to close at all-time highs, but it required 19 billion shares traded, 20% above normal volume. When modest gains demand excessive effort, the system is telling you something important. Most investors missed this signal entirely, focused on the headline numbers rather than the structural shifts occurring underneath. This creates an exploitable opportunity for those who understand what drives market behavior. Human psychology operates predictably during transitions, and we're witnessing a classic late-cycle rotation disguised as continued strength. The crowd sees record closes and assumes momentum continues. The disciplined observer sees distribution patterns and prepares accordingly. The human layer revealed itself through competing emotional states this week. Relief and recalibration battled as participants entered the new year with residual optimism from 3 consecutive double-digit gain years. Yet anxiety emerged quickly as money rotated from technology into cyclicals and value stocks. This wasn't panic. It was prudence dressed as profit-taking. The market collectively acknowledged that artificial intelligence narratives, while structurally sound, had been priced to perfection. The jobs report delivered a Goldilocks outcome that satisfied neither bulls nor bears completely. Weak enough to keep the Fed sidelined, strong enough to avoid recession fears. This ambiguity bred tactical positioning rather than conviction, visible in oscillating sector leadership. Defense stocks surged 8% on budget proposals, while semiconductor memory companies jumped 14 to 28% on infrastructure demand. Meanwhile, Nvidia and Oracle declined modestly but persistently as investors questioned sustainability of current valuations. Beneath calm headline indices, the system churned violently at individual stock levels. The Russell 2000 and Dow outperformed tech-heavy indices early in the week, reversing last year's concentration pattern. Energy and financials led Monday's advance on Venezuelan oil policy clarity, then reversed Wednesday as crude prices collapsed. This illustrates how quickly narrative-driven rallies unwind when fundamentals reassert themselves. The bond market provided the week's most important signal. The 10-year Treasury yield held above 4% despite weak jobs data, indicating inflation expectations remain sticky and constraining Fed flexibility. When unemployment sits at 4.4% and payrolls miss estimates, yet yields refuse to fall, the market is pricing persistent inflation or fiscal concerns that equity investors are ignoring. This divergence between fixed income and equities creates fragility. Bond markets have predicted the last 7 recessions, while equity markets have predicted 0. The upcoming inflation data matters not because it will change the Fed's January decision, but because it will reveal whether inflation's decline has stalled, forcing a repricing of the entire rate path for this year. Commodities markets revealed structural tensions as gold gained 4% weekly and silver surged 12% despite rising real yields. This violates textbook relationships, suggesting central bank buying and geopolitical risk premiums are overwhelming traditional correlations. Bitcoin's failure to break higher despite institutional infrastructure confirms it remains a high beta risk asset trading with Nasdaq liquidity conditions, not a macro hedge. The volume and breadth data expose the market's fragility beneath calm surfaces. High volume on modest gains indicates distribution, not accumulation. When 19 billion shares trade to produce a 0.5% advance, large participants are repositioning, not adding exposure. The advanced decline ratio appeared healthy, but Thursday's tech sector rotation showed information technology falling 1% while value stocks surged. This internal churn signals a market searching for leadership rather than confirming it. The system rewards those who distinguish between what they can control and cannot control. Participants cannot control Fed policy, geopolitical events, or earnings outcomes. They can control position sizing, sector exposure, and the discipline to act on structure rather than narrative. The disciplined approach interprets high-volume, low-gain sessions as warnings to tighten stops, reduce leverage, and wait for clearer directional signals. Markets that churn at the stock level while indices drift higher are markets searching for catalysts, not confirming trends. The rotation from growth to value represents reversion, not trend. Reversion is neither bullish nor bearish. It's mechanical. The earnings season beginning with major banks provides the next structural test. If results disappoint or guidance weakens, sector leadership evaporates, removing a key pillar supporting broader markets. The system revealed its nature this week. Fragile at extremes, resilient in the middle, increasingly dependent on external catalysts rather than internal momentum. The market rewards preparation and discipline to act when probability aligns with structure, not prediction or emotional reactions to daily noise. If you value systematic analysis over market emotions, subscribe for disciplined insights that cut through the noise. Download the complete framework from the link below to master the 3-layer approach to market exploitation.